So the stock market is partying like it's 2021 all over again because Wall Street smells cheap money in the air. Stocks are soaring on the expectation that the Federal Reserve is about to reverse course and start cutting interest rates in the very near future. That's right. After years of high rates to fight inflation, traders are now betting big time that easy money is coming back. But the question is, how big? Well, futures markets put the odds of a Fed rate cut by this September at well over 90%, according to money.com. And the Fed's own projections signal at least two rate cuts by the end of this year. So that's great news. So no wonder the S&P 500 just jumped to the brink of a record high. The bulls are running wild on rate cut euphoria. But wait, could the Fed really slash rates just a few weeks from now? And if so, what does that mean for your money and your investments? Well, everyone thinks they know the answer, right? Stocks only go up, right? But today, we're digging into the truth behind this easy money frenzy. Now, here's the spoiler alert. There's a plot twist involving the White House, and you won't believe who's pushing hardest for those very same rate cuts. So the question is this rally built to last, or are we partying on the edge of a cliff? So let's break it all down. First of all, here's the big picture. So the Fed's benchmark interest rate is currently sitting around 4.25 to 4.5. Now that's a level that's relatively high by historical standards. Now, those high rates have been like gravity pulling on stocks until now. Why? Because inflation, the very problem those high rates were meant to crush, well, it's dramatically cooled off. In fact, the latest consumer price index came in at only 2.4% year over year, essentially almost hitting that Fed's 2% inflation target. So, with inflation apparently tamed and the economy showing signs of slowing down, investors are now convinced the Fed will have to pivot and they'll have to start easing up. So, just look at the market bets for a minute. Virtually nobody expects a rate hike anymore. Instead, traders are counting down to a rate cut liftoff. Now, the Fed's next meeting is July the 30th, but as of now, there's roughly a 77% chance they won't cut at that particular July meeting. However, by the September meeting, expectations shoot through the roof. Practically 9 in 10 investors believe the first rate reduction will happen by then. Again, that's according to money.com. So, in other words, Wall Street has circled September 17th, 2025 in bright red on the calendar as the start of the easier money era. Now, even the Fed's own dot plot forecasts show policymakers penciling in 2/4 point cuts before 2025 actually ends. So, why do these rate cuts have the market in such a frenzy? Well, because lower interest rates equals cheaper money. So when the Fed cuts rates, borrowing costs for businesses and consumers come down. So think cheaper mortgages, cheaper car loans, credit cards, and that puts more money in people's pockets to spend. So companies find it easier to finance projects or stock buybacks. It's kind of like hitting the gas pedal on the economy. Now, in the past, every time the Fed opened up the money spigot, stocks and other assets soared. So traders today are essentially giddy at the thought that the Fed is about to make it rain once again. The result? Well, the Dow surges hundreds of points in a day. The Nasdaq and S&P 500 rip higher, all on the mere anticipation of easy money being just around the corner. Now, of course, this could be great news for your portfolio if it all comes true. But here's the $1 million question. If inflation is back down and everyone expects cuts, why hasn't the Fed cut rates already? What's the holdup? And is there any chance the market has it wrong? So we're now halfway through this video. Let's take a quick pause for something important before we answer those questions. So if this is your first time, welcome to the Financial Freedom Network, the channel that exposes the truth behind your money, your credit, and your future. So if you care about keeping more of your hard-earned cash, boosting your credit score, and of course, staying ahead of the financial curve, just smash that like button and subscribe right now. Trust me, every video that we release could change the way that you live. So buckle up because this one's no exception. So let's continue. Now, back to the burning question. Why isn't the Fed cutting rates today given all these positive signs? Well, the answer lies with one man, Jerome Powell, the Fed chair, and his cautious view of what's coming next. So Powell just testified in front of Congress and basically said, hold your horses, Wall Street. In so many words, Powell argued that if we look in the rearview mirror at the recent low inflation data, sure, it very well might justify cutting rates now. But the Fed doesn't drive looking backwards. It looks at the road ahead. And up ahead, Powell sees a potential inflation speed bump that makes him tap the brakes. What is it? You guessed it, tariffs. Yeah, the trade tariffs that have been in the headlines, higher import taxes on Chinese goods and others, could very well push prices back up in the coming months. So, in Powell's view, these tariffs are wild cards that could very well reignite inflation later on this year. So, Powell told lawmakers that virtually all the economists that he knows, both inside and outside the Fed, expect inflation to meaningfully increase over the course of this year, despite the recent cool down. So I guess in plain English, he's worried that cutting rates too soon, well, that could just pour gasoline on these rekindled inflation embers, especially with tariff related price hikes possibly in the pipeline. Powell's message to the market was essentially, hey, we're in no rush to cut. Now, he emphasized that the US economy is still reasonably strong. The job market, while a bit softer, is solid. So there's no emergency that forces an immediate rate reduction. As long as unemployment isn't surging and inflation expectations remain anchored, well, the Fed can afford to wait and see a little longer before flipping to any rate cuts. Now, this cautious stance explains why the Fed held rates steady at that June the 18th meeting. And it also explains why most Fed officials signaled that they didn't support an instant rate cut at that particular time. In fact, according to the Fed summary, they unanimously voted to pause in June, opting to gather more data rather than act prematurely. However, not everyone at the Fed is as patient as Howell. There's a bit of a debate at the moment inside the central bank. So the case in point is Michelle Bowman, a Fed governor, excuse me, and Christopher Waller, the Fed vice chair for supervision. Now, both of those people have hinted they'd be open to cutting rates sooner, possibly as early as the next meeting in July, if inflation pressures stay contained. Bowman said that if inflation remains tame, she'd support lowering taxes as soon as the next meeting, and Waller made similar remarks. Their logic? Well, they think the inflation blip from tariffs will be a one time bump, not a lasting problem. So, in other words, if underlying inflation is truly under control, why wait? Especially when high rates are starting to bite consumers through pricier car loans, pricier mortgages, and higher credit card interest. Well, the more dovish voices at the Fed are basically saying, well, let's not strangle the economy by keeping rates unnecessarily high. Powell, though, remains unconvinced that it's time to pull the trigger in July. So when he was pressed by a congressman on whether the Fed might cut rates in July, Powell carefully replied that inflation stays low and the job market weakens, we will get to a place where we cut rates sooner rather than later. But he added, I wouldn't want to point to a particular meeting. I don't think we need to be in any rush. The translation of what he said? Well, the July cut isn't off the table, but hey, don't count on it. Now, the Fed wants to make sure inflation is truly beaten and not about to flare up again. Powell even noted the economy is still strong and they'd like to avoid flip flopping on policy unless it's absolutely necessary. So the base case remains hold in July, cut in September, bearing any big surprises in the data over the summer. Now, to give you some context, lawmakers at that hearing grilled Powell by pointing out that central banks all around the world are already loosening up. Interest rates in many other countries are far lower than the US. For example, the European Central Bank rate is about 2%. Japan's nearly zero. Even Canada and the UK have got rates a little bit lower, around 4% or below. So they asked essentially, why aren't we cutting like everyone else? Why are Americans still paying 4 to 5% when the other nations are easing? Powell's answer boiled down to, well, hey, our situation is different. The US economy is still running relatively hot, and our inflation might climb again due to these tariff uncertainties. Now, if we only looked at the recent past, he admitted, you could make a good argument for cutting a couple of times to get rates to a neutral level. But looking forward, given forecasts of rising inflation, Powell insists on a wait and see approach. So he basically told Congress the Fed is watching the effects of the tariff and they won't hesitate to cut later, but they're not going to jump the gun just because other countries are. So that's the no rush mindset in a nutshell. So while Powell is tapping the brakes over at the White House, they're doing the complete opposite and slamming the accelerator. Trump is absolutely livid that the Fed hasn't cut rates yet. He's been publicly bashing Jerome Powell in increasingly personal terms, essentially blaming Powell for holding the economy and the stock market back with too higher interest rates. In a jaw dropping rant at a recent press conference, Trump called Powell a very stupid person with a low IQ for keeping rates where they are. He even mocked Powell as a very average mentally person, an odd turn of phrase, and slammed the Fed's policy as costing the government a fortune. Now, why is Trump so upset about these high rates? Well, the answer is money, lots of it. Higher interest rates mean the US government has to pay more interest on its $30 trillion debt. Trump pointed out that if interest rates were just 3% lower, say around 1.5% instead of 4.5%, the government would save roughly $900 billion a year in interest costs alone. And that is a mighty big number. So, in his words, we're going to end up paying maybe 2 or 3 points more. To Trump, keeping rates high is basically burning hundreds of billions of taxpayers' dollars for no very good reason, and he's absolutely furious about it. So, in other words, he'd rather juice the economy and the markets today with cheap money and deal with any inflation consequences further down the road. From Trump's perspective, the Fed is needlessly choking growth and it's keeping borrowing costs very high for consumers and businesses when inflation is already low. We've got a tremendous economy, Trump said. There's no reason to keep interest rates this high. He believes that immediate rate cuts would not only save the government money, but also supercharge investment and keep the economic expansion absolutely roaring. And it's not just talk either. Trump has the power to reshape the Fed, and he's already moving in that direction. Remember, Powell's term as Fed chair is set to end in early 2026. Now, normally, a president would wait until maybe a few months before that to nominate a successor. But Trump has made it clear he's not going to sit around. He's already announced he's already narrowing down a list of replacements. And here's the kicker: he might announce the next Fed chair much earlier than usual. Why? Well, to effectively undercut Powell and give the markets what they want to hear. Now, think about this strategy for a minute. Powell still has around a year left leading the Fed, but if Trump names a new incoming Fed chair well ahead of time, especially someone loudly in favor of slashing rates, well, it could turn Powell into a lame duck virtually overnight. Now, the new nominee will be essentially backseat driving the Fed policy before even taking office. It's kind of a bold, almost unheard of situation, but it seems to be what Trump is angling for. So, any nominee that Trump chooses will almost certainly be someone who agrees that rates should be much, much lower as soon as possible to support the economy. The under the table deal will be fairly obvious. I'll nominate you and you'll cut rates big time. Now, whoever it is, if Trump makes that early nomination, brace yourself for a complete market frenzy. So the question is, where does this leave all of us? Well, we have a stock market soaring, not because of the current economic strength. Actually, the GDP growth is decent, it's not spectacular. Or even stellar earnings, they're fine, but they're not amazing. But largely because of the expectation of easier monetary policy ahead. Investors are effectively front running the Fed, buying up stocks now to get ahead of the wave of money that they anticipate will flood in once rates begin to drop. So this is classic don't fight the Fed behavior in reverse. When traders sense the Fed is about to loosen up, well, they jump into risk assets with both feet. So as a result, we're seeing major indices near record highs, even while some parts of the economy, like, say, manufacturing or the housing market, are still lukewarm. It's all about the Fed pivot. Now, make no mistake, excuse me, the fuel behind this rally is the prospect of cheap money. The surge in liquidity marks the end of the Fed's tightest phase and a return to expansion. So it's basically confirming what the market suspects. The era of aggressive tightening is now over. Easy money with lower rates and ample cash in the financial system appears to be on the way back. And that is like rocket fuel for asset prices. So finally, here's the bottom line. The stock market's explosive celebration right now isn't so much about a booming economy or a skyrocketing corporate profits. It's about policy. It's about traders anticipating that the Fed, well, they'll soon hand out the ultimate treat, those lower interest rates and an easier money environment. So everyone from professional investors to 401k holders know that when the Fed loosens up, it tends to lift the prices of stocks, real estate, even crypto, everything. And that's the truth behind this rally. It's Fed driven. Now, as one investment analyst quipped, lately good news for Wall Street is defined less by economic reports and more by how fast can the Fed start the money printers all over again. Now, we'll have to watch the upcoming Fed meetings closely. The countdown to the September meeting is on, and markets have basically priced in that rate cuts are a done deal. So any hint that the Fed will follow through or even act earlier, well, that could send stocks to a very, very new record high. Now, on the flip side, if something derails those plans, volatility could return in a flash. Either way, you can bet we'll be here monitoring every twist and turn of this unfolding story. So, in the meantime, thank you for watching. Have a wonderful day and stay tuned to this channel.